Hey everyone, it's Mike Bonn with the Cash Flow Company. Today I want to go over what is changing, what's happening out there in the DSCR market. We're seeing a lot of positive changes besides, rates coming down. So I want to take this time, dive in, show what's new, and see how it affects the investor, how it could put more money in your pocket, qualify for more deals, and maybe even look at just locking in a DSCR without the prepayment. So one of the new options out there that we're talking to investors about who are looking to expand their cash flow is the 40-year mortgage. So with the 40-year, you're going to get a lower payment. Where that lower payment comes in compared to a 30-year amortized loan is when you're looking to qualify. Because if you're only looking for cash flow, you probably just go with the interest only. But if you're looking for at least a little bit of amortization, meaning paying down that loan, that's where the 40-year comes in qualifying. What I have here is an example of a client looking at purchasing a property. It's about a $250,000 loan and their rents are at $2,000. So when we look at product options for someone in the DSCR looking at the 30-year compared to the 40-year, what it does is it shows you that more properties qualify based on their DSCR ratio. So let's look at a couple numbers. Let's say at a 30-year amortized loan on a DSCR, $250,000 with some good credit, we're looking at an interest rate of 6.65 in this current environment. On that $250,000 loan, the payments are going to be $1,596 and some cents. You add taxes, let's just say $200, insurance, $250. What that leaves us with is about $246 for our expenses when we're calculating the DSCR ratio. Now, if we have rents that are $2,000, and we have expenses that are $2,046, we understand that that loan amount, the property is not going to qualify for a DSCR rate of 6.65. It may qualify, but it's going to be a negative AM loan and the rate's going to go up, and not going to help our cash flow. But let's take that same property, put it into a 40-year fixed. Even though the rates will go up, in this case, we're going to look at a rate of 6.9%. On the 40-year amortization, $250,000 in loan balance, our payments now are going to be $1,535 and some cents. Add in the taxes and insurance, and now our expenses are going to be just under that $1,985. In this example, the 40-year product is going to help us qualify for the $250,000 mortgage. There are some other ways around this, maybe lower the $250,000 and keep it into a 30-year, but some people also just want cash flow. So if you're looking for better cash flow, or just to qualify, that's where the 40-year product comes in. All these products now are designed to get more properties into your portfolio, create that wealth. The other big change I'm seeing out there is the option to do no prepay penalty on the DSCR loan. So typically on a DSCR loan, you're going to see a prepay payment of 5, 4, 3, 2, 1, meaning a declining prepayment over the 5 years. But a lot of investors wanted to get into a DSCR loan, but not lock themselves in. So now there are options out there for the zero prepay, meaning there are no prepayment penalties on your loan. So if the market keeps getting better, you can refinance it into a new loan. Now, the flip side of that coin with the zero prepays is the rates are going to be higher, typically about 1 point. So you want to weigh the difference between a better rate with a longer prepay or no prepay so you can refinance as the rates hopefully keep going down over the next year. Another option out there that we're seeing is the 1-year prepay. So you're not going to take as big a hit on the rate when you go to the 0% because remember on the 0%, like I said before, you're going to increase your rate about 1%. But there are now prepays out there for like 1 year. So you have to keep it 1 year. After that year, you could pay it off at any time, refinance, sell the property, whatever you would like to do. So there are options now. There's the traditional 5-year, there's a 3-year, but the 3-year doesn't really help you that much in this kind of market if you're looking at rates going down. I would look more at the 1 year, or if you're really certain the rate's going to go down, you need the lock-in right now, even look at the 0%, pay the higher interest rate, and have the flexibility to jump out of that loan into a lower rate as soon as rates drop. That being said, we don't know where interest rates are going to go, but it may take a full year, it may take 18 months for us to really see the bottom of where this is going. So as you're looking for the DSCR, what's the best option? We know one thing, rates have come down, there's more properties that are qualifying, helping the cash flow, getting more money into your pockets, all the great things. Now let's look at the other options out there, the 40-year, the no prepay, maybe even the 1-year prepay, to make sure you put your portfolio in the best situation that it helps you create that wealth. We'll keep updating you as products change because they're going to change as rates come down, as the market in the real estate community grows as rates go down. We're going to see more product options out there. We'll keep you informed of that. If you have any comments, questions, just leave them below. And also check out our site, thecashflowcompany.com. You'll find some great tools there, like the DSCR calculator. You can put the numbers in, find out if your property actually breaks even. It's that DSCR ratio mark. So it's required for you to get one of these loans.